Hello, welcome to the lecture on monetary policies. This is the first of the two audio recordings on this lecture. What are monetary policies? Monetary policies are one of the two main types of macroeconomic policies adopted by macroeconomic policymakers to address a problem in the economy. These problems are typically one of three things. It's either a low GDP growth or higher than expected inflation or higher than expected unemployment. So the other types of policies are called fiscal policies. And as you would remember from our lecture on fiscal policies, these are the type of policies that impact the government's budget directly. And that's why they are called fiscal policies, which means government budget policies. And accordingly, they are adopted by the political leadership. The president, his economic advisors, and the Congress adopts fiscal policies. On the other side, monetary policies are they target to change the level or change the money conditions in the economy. So it's a technical matter, and accordingly, technocrats or macroeconomists adopt these type of policies. Specifically, it's the Federal Reserve, shortened as Fed, which is the central bank of the United States, that adopt these policies. So for us to have a good understanding of how monetary policies work and why they are adopted, we first need to understand how our money system works. At the core of our money system is the banks. Banks are the crucial institutions in our economy. And the reason for that is banking system functions as the bloodline for the economy. By issuing loans for businesses in the economy, it makes sure that the economic growth is fast. So unlike any other business in the economy, let's say healthcare or higher education or automotive manufacturing, etc., it is much more difficult to contain a crisis that happens in the banking sector. In all other sectors, when a problem arises, then it typically impacts only the companies that are in that particular sector. But in banking sector, when banks are in trouble, they stop lending, and because lending stops, then all other businesses in all other sectors in the economy cannot find the money that they need to invest, to expand, and to create new jobs, and the economic difficulties surface. That's why banks are so important for an economy in any country. Another reason why banks are so important is because they create vast majority of the money that circulates in the economy. Now, this may sound a little counterintuitive to you. If I ask you, who do you think creates money for us, your response would most likely be the U.S. government. And that answer would be correct as well. It's not incorrect. U.S. government, and specifically the U.S. Treasury, creates money in the sense that when we consider money as the printed money only. So the actual currency we keep in our wallets, or the change, the coins we keep in our pockets, are indeed produced, manufactured by the U.S. Treasury, and it's the U.S. government is the only institution that's legally allowed to do so. Not even state governments are allowed to print money, as you know, as the U.S. Constitution only authorizes the U.S. government to do it. However, printed money and coins are actually a very small percentage of the money circulating in the economy. The vast majority is money created by banks in digital form through the loan issuing process. This system is called fractional reserve banking. Fractional reserve banking refers to the banks being required to, by law, to keep a certain percentage of the deposits they receive in reserves and not touch it. They keep them for the rainy day and issuing loans with the remaining portion. So say you saved $100 at the end of the month and you took it to your bank, deposited in your bank account. Bank keeps 10% of that money in its vault, or it sends it to its account with Federal Reserve and it stays in Fed's vault. Either way, it's the same thing. It is a rainy day fund, if you will, and they are not allowed to touch that money for any purpose whatsoever. And then banks are allowed to issue loans with the remaining 90% of the money that you deposited. So 90% of your $100 deposit is $90, and your bank issues out a loan in the amount of $90. But the key thing to know here is that that money is issued digitally, not physically, which means that that $90 loan enters into the bank account of the borrower from your bank. It could be a student loan, it could be a car loan or a mortgage loan, doesn't matter what type of loan it is. Someone borrows money from your bank and your $90 enters that borrower's bank account digitally. It's sent by your company, your bank, to that borrower's bank digitally. So this borrower's bank does the same thing that your bank did at the first step and keeps 10% of this money, which is 10% of $90, $9, in its vault for the rainy day in reserves, and issues loans with the remaining 90% of that money. So 90% times $90, $81, and it does it digitally, just like how your bank did it. So now $81 enters into the bank account of some second borrower in the economy in this picture. And that bank does the same thing, keeps 10% in reserves, which is 10% of $81, $8.10, and issues loans with the remaining 90%, which is 90% times $81, $72.90. And that bank does it digitally as well. And as you can see, this process continues, but it will end at some point because the amount of loans is getting smaller and smaller at every step. It was $90 first, $81 second step, and $72.90 at the third step, which means that some banks later, this process will zero out. The amount of loans will be zero. But the key thing to know is that the actual amount of money that is actually deposited into the banking system is only $100 that you deposited in your bank account at the beginning. But when we take a step back and look at the entire process of what happened as a result of your deposit and the subsequent loan issuing processes, we see that the amount of loans that are issued were several times the amount that you deposited in your bank account, which is $100, right? So economically speaking, aggregate effective demand has risen by several times the amount that you deposited in your bank account at the beginning. In other words, purchasing power in the economy rose several times your original deposit. So graphically speaking, it resembles something like this. $100 deposited, your bank account keeps 10% of it in reserves and loans out the remaining 90%. And then the second bank does the same. Then the third bank, the fourth, fifth, sixth, seventh bank. So when we look at the U.S. economy today, 97% of all money supply, all the money circulating in the U.S. economy is money that's created digitally in the form of a loan. And this through this process called fractional reserve banking. This is another way of saying that only 3% of the money circulating in the U.S. economy is the actual physical currency, dollars and the change. Fractional reserve banking is called as such because it's the system that requires banks to keep a fraction, a very small percentage of their deposits in reserves. So if you forget this term, you can always remember it from its description this way. And currently that rate is 10%, by the way. Money multiplier in the US economy is around 9 today, which means that every dollar that you deposit in your bank account leads to banking sector collectively creating $9 worth of loans for the economy. So you deposited $1, it creates $9 of purchasing power for some actors in the economy. So money multiplier is 9. So this fractional reserve banking system is the reason why reserve requirement is such an important thing. It's partly art, partly science that to determine the appropriate level of reserve requirement for an economy. Accordingly, it's the Federal Reserve's job to do that. And Federal Reserve, if they make a mistake and they determine the Federal Reserve requirement too high, then it creates opportunity costs for the economy, meaning that more than necessary amount of money would stay in bank vaults in an idle fashion, which means some part of those monies would not be entering the economy, stimulating further growth and investments in job creation. Opportunity costs for the economy would be higher. If on the other side, Fed keeps the interest rates too low, then it makes the entire system vulnerable to crises, because it would make banks operate with less than what's needed cushion for the rainy day. So when the rainy day comes, there's not enough money in cash form for the banks to rely on. So when banks go down, they stop lending, and the entire economic activity halts as a result. This wraps up our discussion, the first of the two recordings on monetary policy. Please check out the second video below as well.